Good morning, good afternoon, and good evening, and welcome to our Q3 2022 webcast. I'm Gary Berchowitz, a partner in our Global Corporate Reporting Group. And today I'm joined by my colleagues from the global team, Scott Bandura and Laura Kennedy. In this webcast, we're going to focus on some topical issues, which you can see on the slide. This includes an update on the Globe Pillar 2 taxes. We'll also talk about an amendment which is coming up very soon, I think, on presentation of current and non-current liabilities. We'll give you an update on the latest that's going on from an ESG perspective. We'll also talk about rising inflation and interest rates, and more importantly, which accounting standards or areas you should be thinking of as a result of this. And lastly, we'll talk about a recent discussion that the board had on cash received via electronic transfer as the settlement for a financial asset. That's quite a mouthful, but folks who've been following it will know exactly what I mean. As always, if you'd like to jump to one of these topics, please use the timestamps below. And final reminder that this webcast is for general information only and is not a substitute for consultation with professionals. Hope you enjoy. Right, so just a quick update on the OECD's Pillar 2 tax reforms or globe rules or any other name they're referred to. Now, we discussed this in a fair bit of detail in our June 2022 webcast, and this is just really an update. At the time, we said folks may want to start thinking about disclosures potentially, because again, until the tax reforms are actually implemented from a local legislation perspective, it's currently really more of a question around disclosures. We did, however, put a big question mark around once they are enacted, once the reforms are enacted locally, whether or not this is going to give rise to deferred tax considerations, which would be incredibly complex. Now, the update we've got now is that in the September staff paper to the board on their work plan, the staff have actually noted that they will be bringing a paper back to the board, which discusses the Pillar 2 requirements and also will help the board consider whether or not urgent standard setting is potentially needed around this aspect, we imagine, within the realm of deferred tax, because that is where it's going to be potentially incredibly complex and potentially misleading. And so I think it's a bit of a watch the space. As we said, at this point in time, we're not expecting any territory to enact or substantively enact the requirements before the end of the year. And so it's really continues to be a disclosure point for now. And I guess watch the space and see what the staff bring back to the board to discuss, hopefully before the end of this year. Okay, let's talk about liabilities and their presentation as current or non-current on the statement of financial position. And this first slide really just tries to tell the story so far, because it has been a story or a saga that's been going on for a while. So folks may know that today we assess whether or not liabilities should be presented as current or non-current based on whether or not the entity has the right to defer payment for 12 months or more. Now, in 2020, the board issued amendments that would be effective from 2023. And those amendments actually changed the principle of how we determine current and non-current. And it basically said you need to now assess whether or not hypothetically you would comply with those covenants at the reporting period. And if you hypothetically would comply, it's non-current. And if you would not, it becomes current. There was a fair amount of pushback on those proposals, and so the board took that under consideration, taking into account the new information they received. And I think they've done a great job in actually issuing revised amendments now, or at least we're hoping the revised amendments should come out in November. And those revised amendments will change the principle again to basically say that you assess what the rights and obligations are at the reporting date. So we've got an example that kind of brings this into focus. But folks may wonder, why are we talking about amendments that are only going to be effective in 2024? And the reason is because the 2022 amendments, which should come out this year, although they're only effective in 2024, the 2020 amendments would have been effective next year. So if you are worried about this for next year, the good news is you hopefully won't no longer need to worry about it. And let's just work through an example to explain why. So let's take a look at that example. Assume we have an entity that has a loan. It has a repayment date sometime in the future, 2025, and this loan has certain covenants. It's got a covenant that is tested on the 31st of December every year, and it requires a ratio of 1 or greater. Now, we have a reporting end date, hypothetically, of end of September, 30th of September, And at the end of September, the ratio is currently only 0.9. And so the question is, how should you classify the loan in your 30 September financial statements? And also assume that at this point in time, management thinks it's probable that they're going to be able to meet the condition by the covenant testing date. It's 50%. It's more likely than not, but they don't feel really confident. But they feel pretty good about it. So I think currently we have, under our current requirements, this loan would still be presented as non-current at the 30th of September, because at that time you still have a contractual right to defer settlement for 12 months. The 2020 amendments would have actually said you pretend that you test the covenants at your reporting date. And if this covenant testing had actually been done at the 30th of September, the entity would have failed because its ratio of 0.9 would have been less than what was required. And so under the 2020 amendments, this loan would have been classified as current in the September financial statements. The 2022 amendments, so the new amendments that will hopefully come out in November, will actually reverse that and say, no, you continue to assess the rights and obligations as they exist at the reporting date. And at the reporting date, 30th September, the entity still has the right to defer settlement for more than 12 months because there is no covenant testing at that point in time. However, the new requirements will require additional considerations of disclosure, and we'll look at some of the details around the new requirements on the next slide. So 3 key points we wanted to highlight with respect to the 2022 amendments. The first we've hopefully covered in the example we just went through, which is the principle of whether or not something is current or non-current is based on the rights and obligations at the reporting date, and therefore you only consider covenants that are tested on or before the reporting date when assessing whether or not something is current or non-current. And as we mentioned before, that's a shift from the 2020 amendments, and we think a good shift and good job to the board for taking that under consideration. The second is just around presentation and disclosure. For a while, there was a proposal that all liabilities that have covenants should be presented separately on the face of the statement of financial position. They've moved away from that, so you can still present all your non-current liabilities together. However, there are new disclosure requirements around the volume of liabilities that are subject to covenants. Any important things users should know with respect to those covenants need to be included as well. And looking at that example we had on the slide before, if there was a covenant which you are currently not meeting hypothetically at the reporting date, but you thought it was probable you were going to meet it at the end of the reporting date, and that's something that was important for someone to know, that's the type of additional disclosures now that will be required based on the 2022 amendments. So some additional disclosures, but I think we're in a much better place than we were. And the last thing about transition, and this is what's, I guess, important with respect to why we're talking about this now, I mentioned that these amendments are only effective in 2024, but they also defer the effective date of the 2020 amendments. So the 2020 amendments are also applied in 2024. So in other words, this will overwrite the 2020 amendments once they all get applied in 2024. So hopefully that's good news. People can carry on, bottom line, people can carry on doing what they've been doing today. And by 2024, when you adopt these new amendments, you probably just need to be aware of the new disclosure requirements that are going to come along with that. As I said, this is almost done and dusted. We're hoping that the final amendment will be issued in November 2022, but we're not expecting any changes from what I've just discussed now. So some good news there. Watch this space.
Hello. A couple of months ago, we submitted comment letters for both the ISSB and ESRS draft standards, and today I wanted to briefly take you through just a few of our main comments on these exposure drafts. On the slide here, you can see just a few of the themes that we raised in our comment letters. I'm focusing in on the issues that we've raised that cut across both sets of standards, but in the links at the end of the presentation, you'll be able to find more detail on our responses. If we first focus on materiality, the ISSB and ESRS exposure drafts have two different methods of considering materiality. We agreed with the ISSB's approach for assessing materiality. That is, the global baseline should be focused on enterprise value. In this method, an item would be material if it impacted the enterprise value of an entity. An enterprise value is defined by the ISSB standards as the total value of an entity, being the sum of the value of the entity's equity, that is its market capitalization, and the value of the entity's net debt. We recommended that the final standard be explicit that enterprise value should be assessed through the lens of a market participant using a fair value concept as described in IFRS 13 fair value measurement. And although we do recognize that the ISSB focused on investor materiality, we also acknowledge that they are working with GRI and that some companies may wish to use or disclose items above this baseline and focus more on a double materiality lens. The ESRS exposure drafts, on the other hand, do focus on double materiality, both looking at enterprise value and impact materiality. Impact materiality is the impact that the entity's activities have on people, the planet, and the environment. We also recommended that where entities make disclosures along this double materiality line, that there should be clear disclosure of what is material from an enterprise value perspective and what is material from an impact perspective. And we recommended that the FREG make it clear how entities are to determine materiality along impact lines. In terms of interoperability, I think here we're talking about consistency across different standards and integration within standards. So first, focusing on consistency across the different standards, we responded to the ISSB, the FREG, and the SEC, and we consistently asked them to continue to collaborate with each other on the development of a consistent global baseline of reporting standards with additional jurisdictional requirements laid on top of this baseline if and when needed. We think it's important to have this global baseline so that companies are at least starting from the same place when it comes to sustainability reporting, and we recommended specifically that the FREG consider integrating key concepts and the definitions being used by the ISSB into the ESRS to the extent that there's consistency between the two sets of standards. In terms of integration within the standards, specifically for the ISSB standards, we noted that in the current exposure drafts, there's limited linkage between the two proposed standards, one being the general standard and the other the thematic standard on climate. Without a clear linkage, we think there's a risk that where the two standards overlap, preparers may feel compelled to give duplicative disclosures, and obviously this would be inefficient, and a duplication of disclosure might actually obscure material information. We proposed a holistic approach such that reporting under both standards, the general and the climate, would not be segregated but seen as one report, with the principles in S1, the general standard, providing a framework for all standards. As such, the thematic standards would then provide specific disclosure requirements and guidance relating to the specific key ESG disclosures relating to that topic, for example, biodiversity. In terms of assurance, we believe that in order to meet expectations of investors and other stakeholders, the ultimate ambition for sustainability disclosures should be reasonable assurance over the entirety of an entity's disclosures on significant sustainability-related risk and opportunities, and we think this applies regardless of which set of standards the entity applies. We acknowledge that there are challenges in verifying and assuring non-financial information generally, which the standards by themselves, being reporting standards, can't wholly address. There needs to be a collaborative effort between accounting and assurance standard setters, preparers, and practitioners to establish the framework needed to deliver on that ambition of providing and assuring these kinds of disclosures. And in order to support this effort, we recommend that the standards require entities to disclose information about the underlying judgments and assumptions made when determining materiality and providing more clarity on specific terms and definitions within the standards. In terms of reporting boundary, across both the ISSB and ESRS standards, we've asked the standard setters to give more precise details on what the reporting boundary is for the purpose of non-financial reporting. For example, within ESRS, there will be a requirement for entities to report on risks within their value chain, but the current draft standards are not clear how an entity is expected to determine the limits or the boundaries of their value chain. The standards also suggest that entities should be making a reasonable effort to get the relevant information from entities within their value chain, but that reasonability is not defined. And we suggested it would be helpful to give examples of what this might look like or how it might be applied in practice. Within the ISSB standards, we think the standard setters need to be more clear on how it expects entities to treat associates and joint ventures within non-financial reporting. Currently, the exposure draft suggests that individual thematic standards will mandate how entities should disclose or measure risk and opportunities relating to those associates and joint ventures and other such investments. This leaves the question of how to deal with these types of investments been unanswered until such thematic standards are released. To improve the clarity for preparers before the release of the other thematic standards, we recommended that the ISSB established a general principle in IFRS, in the general standard, such that the information should be provided for investments like joint ventures and associates where it's material to investors, but that information should still be clearly distinguished from information given about the consolidated group, so distinguished from consolidated investments. Okay, well, let's zoom in a little bit on the EU proposals. In April 2021, the EU published the proposal for its Corporate Sustainability Reporting Directive, or CSRD, which revises and extends the scope of the current non-financial reporting obligations under its Non-Financial Reporting Directive, or NFRD. In June 2022, the trilogue, being the European Commission, the Council of the European Union, and the European Parliament, reached agreement on the CSRD, and it's effective for companies already subject to the NFRD for financial years commencing on or after the 1st of January 2024. For large companies that are not already subject to the NFRD, the application date is for periods commencing on or after the 1st of January 2025, and there's also an extended date for January 1st, 2026 for listed SMEs and small credit institutions and insurance undertakings. The CSRD brings sustainability reporting in as mandatory as part of the consolidated management report. It includes an obligation for companies to get limited assurance over the sustainability reports. The ESRS standards I mentioned earlier, those will be part of the, those will be the reporting standards required under the CSRD. We don't have time today, obviously, to go into all of the details of the proposals, but there'll be resources linked to this presentation, which you can review if you want more information. The one point we wanted to highlight today, though, is the impact that this directive will have on non-EU entities. Based on the current proposals, the extended scope of the CSRD includes subsidiaries of parent entities outside of the EU. This means that all entities with EU subsidiaries will need to consider whether they'll need to report under the CSRD. So there's a broad sort of extra jurisdictional impact to some companies with these proposals. So the more obvious direct EU companies coming within the scope of the CSRD are those that are listed on EU regulated markets, including companies incorporated outside the EU but listed on an EU market. So if there's either debt or equity listed on an EU market, even a non-European company would be subject. And this is regardless of size, except for very small micro undertakings. However, there is a requirement as well for non-EU companies to provide a sustainability report at a global consolidated level for companies generating net turnover of 150 million euros in the EU, and which, for example, have at least one large subsidiary or branch in the EU generating 40 million euros of turnover, amongst other criteria. A special non-EU dedicated standard is expected to be issued in 2023 and will dictate exactly what reporting is required at this global consolidated level. So companies essentially selling into Europe that have some operations into Europe may need to provide some global consolidated information, which I think is a significant thing to realize for global groups. In addition, all EU parent companies of large groups need to provide sustainability reporting at a group level. The following criteria might lead to a non-EU parent being outside of the scope of the CSRD. So if, for example, there are no subsidiaries or subgroups listed on EU regulated markets, and there are no large companies registered in the EU, there's also the possibility that there might be allowances for other standards to be applied at a global consolidated level if they're considered to be equivalent to the EU standards. However, again, we don't know as of yet whether any standards will be deemed to be equivalent. So that'll be something that hopefully we'll learn more about in the coming time when the other standards are starting to be finalized. Okay, so what's coming next? Well, the ISSB has stated that the standards will be published before the end of this year, and once those final standards are published, it'll be down to local jurisdictions to determine if and when they'll adopt the standards as part of their local reporting framework. So we may see staggered adoption globally on these, but if the standards are released in, say, late 2022 or early 2023, the earliest we would expect adoption would be for likely the periods beginning on or after the 1st of January 2024. For ESRS, we already talked about some of the effective dates. They could be effective as early as for periods commencing on or after the 1st of January 2024 for companies that are already subject to the NFRD. And then there are some staggered effective dates, which I mentioned for those companies not subject to the NFRD and for SMEs and small credit institutions, etc. So I won't go over that again, but you'll see that this has more definite effective dates than the ISSB standards, given that this is a European regulation. Obviously, we've talked a lot about some of the dates and some of the complex scope provisions of some of the standards. So you may want to read more about these, and we've included some links to the related publications that would give you a more detailed overview of some of the requirements.
Item number 4 on the agenda is the impact of rising inflation and interest rates on the IFRS financial statements. The effects of rising inflation and interest rates touch on all aspects of an entity's business. That includes increasing costs, such as raw materials and wages, changes in customer behaviour and their credit risk, negotiation or renegotiation of contract terms, and investment and financing decisions. In turn, the effect on the financial statements is likely to be equally widespread. Rising inflation and interest rates will affect fair value measurement, expected future cash flow estimates, discount rates used to determine present values, and impairment. Soon we'll be publishing an in-depth that will provide a standard-by-standard guide of the key areas of the IFRS requirements where rising inflation and interest rates are likely to have the biggest impact, and what you need to be thinking about for this reporting period. Some of the areas that we'll be touching on will include IAS 19 employee benefits, in particular defined benefit pension liabilities, IAS 37 provisions and contingent assets and liabilities, including the impact on decommissioning obligations, IFRS 13 and the factors to consider when measuring assets and liabilities at their fair value, IAS 36 asset impairments, including the impact on impairment indicators, as well as on expected cash flows and discount rates, and IFRS 9, in particular the impact on expected credit losses. We'll also be covering the need for disclosures, in particular under IAS 1, which requires disclosures about sources of significant estimation uncertainty and also about significant judgments. We'll also be looking at the disclosures under IFRS 7 for financial instruments, in particular relating to liquidity and to sensitivity. So please do watch out for our new publication coming soon. Moving on to our final topic for this quarter's update, cash payments that are sent via an electronic transfer system. Following on from a question that was submitted to the IFRS Interpretations Committee over a year ago now, the ISB has recently decided to explore possible narrow scope standard setting on this topic. Today we're going to talk through what it is that's happened so far that led the ISB to make that decision and what we can expect from any potential standard setting project. So this discussion all started with a question submitted to the IFRS Interpretations Committee. And the question revolved around a pretty simple fact pattern. An entity prepares its annual reports for the calendar year ending 31st of December. 1 month before the year end, the entity sells some goods to its customer and it recognises a trade receivable for the amount due. Then, on the last day of the year, the entity receives a notification that its customer has sent the payment via an electronic transfer. The system takes a few working days to settle the payment, and the cash appears in the entity's bank account on the 2nd of January. And the question asked was this: does the entity de-recognise the receivable and recognise the cash on 31st of December, or does it instead wait until the 2nd of January? The committee concluded that IFRS 9 provides an adequate basis for an entity to be able to answer that question. Relating to the timing of recognising the cash, the committee reached the view that for the fact pattern presented, the cash would be recognised on the 2nd of January when it reaches the entity's bank account and not before. Relating to the timing of de-recognising the trade receivable in the fact pattern, the committee reached the view that the answer was less definitive, and it could be either 31st of December or 2nd of January, depending on the specific facts surrounding that transfer. But despite concluding that IFRS 9 provides an adequate basis to answer the question, the committee was aware that stakeholders have practical concerns about this analysis. In particular, the committee received feedback that if its decision was finalised, it could disrupt long-standing accounting practices, have wider consequences for other fact patterns, for example, payments made by credit cards, and it could lead to costs and complexities for preparers, including changes to systems and controls surrounding bank reconciliations. So, taking this into account and to decide on the next steps, both the technical analysis and the practical concerns were presented to the ISB in September, and on balance, the ISB has decided to explore narrow scope standard setting instead of approving the agenda decision. The ISB has not made any tentative decisions yet, but the discussion it had in September has given us some indications of what a standard setting project could look like. It was indicated that any standard setting would not have an objective of simply allowing entities to retain their existing accounting practices. It would be narrow in scope, meaning it wouldn't amend the general recognition and de-recognition requirements in IFRS 9. It would create an exemption from those general requirements in IFRS 9, only if doing so would not significantly reduce the usefulness of the information produced. It would be scoped in a way that it could be applied across different payment systems and legal environments. And lastly, it would have a specified effective date by which all entities would be required to apply the new requirements. Any amendment would be subject to the ISB's usual due process, which includes a period of public consultation, and the ISB has already indicated that if it does undertake standard setting, any amendment would not be finalised in 2022. In the light of these recent discussions, and in anticipation of any possible future standard setting, entities might be considering disclosing their accounting practices relating to this issue. So with that, we will await the ISB's next discussion on this topic. Please watch this space and we'll continue to keep you updated as the issue develops.
We've covered a lot of ground today and we hope you found this webcast helpful. I also wanted to highlight where to go for additional resources. Our Global IFRS September year-end reminders was recently published. This document covers reporting requirements as at 30 September 2022. It covers topical issues in addition to what we discussed today, and entities might want to consider this for year-end. And it also covers the standards and interpretations that are newly applicable for 30 September year-ends. and standards and interpretations that are not yet applicable, but they're effective in the future that might require disclosure if their impact is material to you. This and a lot of other information on the topics we've discussed will be found on Viewpoint. Thank you very much for listening to us today.